Good morning. My name is Leah Kratz, and I'm one of the authors of your financial accounting textbook. As you already know, Chapter 12 is all about investments. In this particular problem, we're talking about your roommate's parents' ice cream store in Florida. Now, the parents have an issue in that the business is very seasonal. In the warmer summer months, more people want ice cream, which increases revenue and increases cash flow. But in the cooler winter months, not as many people may be looking for ice cream, and therefore revenue decreases as well as cash flow. In an effort to smooth out the cash flow issues, the company has taken some of the excess cash from those warmer summer months and invested them in the stock of another company so that they can then use that cash in the winter months when cash flow might not be as prevalent. This is a very common situation, especially in organizations that are seasonal. But your roommate had a question. Your roommate was concerned that there was a loss reported on the financial statements and the investments haven't even been sold yet. That's a very valid question and one that we're going to explore more in this chapter. Again, these videos are to help support the information found in the chapter. Historically, there's been a big debate as to how we value assets on the financial statements. As you recall from previous chapters, property, plant, and equipment, or those long-term operational assets, were recorded at historical cost. The reason for that is because those assets were intended to be held for many years, long periods of time in which they're going to generate revenue from. For this reason, we want to keep those assets on the books for what we paid for it, because it's too hard to know what the value is at any point in time as they go throughout the years, the many years that they're using it. They wait until the asset is sold to recognize any gain or loss. And historical cost is a figure that is easy to verify. We know what was given up in order to acquire that asset. On the other hand, these investments that your roommate's parents have chosen are stock of another company, and this is what we call equity investments. Those equity investments are going to be reported at fair value, or what they're worth at the time of reporting, their market value. The reason being is because the investments are not necessarily intended to be held for many, many, many years, like the long-term operational assets. These investments for the parents are actually intended to be sold in the next season when the winter months come and cash flow isn't available. For this reason, these investments are going to be reported at fair value. They're going to be sold relatively soon, so there's not as much chance for the value to change drastically. And in this case, GAAP requires that the equity investments be reported at fair value, with any changes in that fair value being reported as a gain or a loss on the income statement. Again, there's a very ready market for these investments. Equity securities, it's not subjective what their value is, because you can look at any moment in time as to what they're trading for on the open market. So the values are not subjective, but rather we can verify, and they have a ready market that they can be sold in. It's not as though it's going to be difficult to find a buyer when it comes time to sell. For those reasons, because they're intended to be sold, there is a ready market, and we can verify that price. That's why GAAP says we should go ahead and record those at fair value at the time of reporting. And again, any changes in those values will be reported as a gain or a loss on the income statement. If the value of the investments goes up, then a gain is reported on the income statement. If the value goes down, it's reported as a loss on the income statement. Now, if you've read through Chapter 12, you know there's lots of different ways that we can actually report investments. For example, we've been talking about equity investments, but companies could also invest in debt securities of other organizations. And depending on the intention of how long they plan to hold those investments determines how they're reported and how those changes in values get reported. Additionally, even if we're buying equity investments of another company, depending on the quantity or the level of investment will determine how we record and report those investments, if we have significant influence or if we actually have control of the organization through our level of acquisition. So as you can see, investments are very interesting. We hope you're learning a lot. I hope you've enjoyed Chapter 12. Learn a lot.